Hello everyone, Steve Lentz here with Discover Options. Welcome to this presentation of the Inside Wire. It is November 28th, 2017. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. So today we are going to continue just discussing a topic here. Let me just check my screens here. Okay. We're going to continue along a subject that we teed off on back in July. Back in July, it was labeled a Friday's Massive VIX trade on July 25th there. You can see that right down here. Okay, so let's go take a look at what that involved. I want to review that trade in the VIX from a trader, and we're just going to see how well his trade has done, he or her, and we're going to just see how it went, and away we go here. So back then, I alerted us to this Wall Street Journal article on July 25th that described a very large trade in the VIX options. And we dissected it back then, and I wanted to kind of go over day by day how well the position is done. The trader eventually rolled the position, and there's anticipation that this trader is going to roll it yet again. Okay, so let's go take a peek. I'm going to run through the same slides very quickly here. You can see even in the article they painted a little risk graph, all right, of the position, and it was pretty accurate. I mean it's at expiration only, but that's okay. I mean, it really depicts it well. And in that sense, they in that article they even pointed out the exact prices and the strikes. So that's great. So we load that up. Here I just throw it into a spreadsheet, what the position was, and they had quantities and everything here. Look at this. This is just something else. And they had the prices. And so let's go take a look at what that trade was. And at the end of the day, what you have is a ratio right for a net debit. And it is, and what assists it in being paid for is the sale of a naked put down here, an in-the-money naked put. So they sell an in-the-money naked put to help pay for this ratio right. And so what happens is you're buying a whole bunch of these calls here. All right, you're buying some calls, and as the VIX moves up, you're going to make quite a bit of money here on these calls. And then when you get to this short out here at 25, everything thereafter, your then profits go lower and lower until eventually you're going to start losing money way on out there at 30, etc. So let's go take a look at that. Here you are over at near 10. You go long these 15 calls. Let's go back up. Yeah, we're going long these 15 calls, and so you start making money at the 15 level here. This is at expiration. All the way up to 25, those calls kick in, and you're making, look at this. I mean, you make, if it goes up to 15, 16, 17, 18, 19, 20, you're making, 70, 100, 140 million dollars on this thing. And when it hits 25, you're peaking out at near 250, 260 million dollars. All right, so it's pretty darn, there's some big money. That's why they call it a massive VIX trade. And so, but that's kind of how it works. Now, what he did is he went in, and so that's the trade. Here's the breakdown. Okay, that's it in a nutshell. It breaks down like this. You're doing a ratio right plus that naked put. So the ratio right, let's just do a 1/2. You're going long this at the money, or this is an out of the money call, selling 2 of these to help pay for that, and you're stuck with this. Okay. Now, what they're going to do is what's not acceptable here is that you have a Jim Graham is typing. Okay, you have a break even here that's just kind of really far out there. Okay, really far out there. So if you could just lift this whole thing up a bit, that would be very helpful in bringing this break even further over. He is known as 50 cent because he likes to buy near-dated VIX options priced at about 50 cents each. See, Jim, I saw that article, And that article that identifies him came out before that Wall Street Journal article. It was someone else that chased down a big VIX trader. And, here you look, and I saw that article, and this is really not and I think he's doing other VIX trades. This is not priced, this is $1.35. So I saw that article dated May. I don't know. Other people are logging in. You look at the comments on these articles that have come out, and there's 2 that have come out since the Wall Street Journal one. Some think it's George Soros, and others. It's interesting. November 20th, well, that was from Yahoo, which also referenced the previous article, I believe. They teed off on it. Oh, it was from Bloomberg. Well, all right. There's other commenters, on those articles that they have different ideas as to who it is. It's I don't know if 50 Cent, the guy named 50 Cent, actually owned up to it or not. But anyway, this trade involves purchasing much more expensive at the money call and then doing a right here. But here's how it works. If you were to then lift this by selling the naked put, you're lifting the break even all the way up to here. So now you don't need such a huge move on the upside for you to start making money. And when you label the two together, here you go. So your break even goes from here all the way down to there, and you zoom in on it, and there you go. A huge difference. A huge difference. Now what's interesting, and you're looking at all this loss here at expiration, and that's true. However, how often has VIX gone down to 8? All right, let's go take a look here. Here's when 50 Cent put the trade on. Look at this. I mean, the close there was, this is on the dailies. This was at a huge long-term low. Huge long-term low. When you go to the monthlies, you could see that it's at the lowest low for years and years. So it's a good chance it's not going to go down to 8. Good chance it's kind of bottomed out, right? Well, the problem here too is you need it to really go up, and the VIX can stay low and remain low and bottom out for a long, long time. So let's go through, and further, you have some time decay wearing on you as well. So, and this is 30 days out. So let's go through day by day and just show you how this worked. Well, I'll do that in a little bit. Fast forward to September 25th. So time goes on. And, and I should have showed you an intermediate graph as to how it went till September. I'm going to show you a day-by-day graph here on the profit and loss of the trade as it went. Bottom line is the trader went and did a rollover on the week of September 25th. It gets to Friday on September 25th, and then they report that the position had been rolled for a loss of about $9 million, according to a person familiar with the trade. Okay, so, and they didn't go into the numbers. That is the exact prices that the rollover was done. However, what I did is I went to that week, ending September 25th, and I went and looked in the matrix and found that on Wednesday, at the close, the position was down 9,000,001. So I figured that's good enough. We're going to take these prices, we're going to roll the trade over by simply buying, the ratio right back, okay, buying it back, going over here, and doing the same exact position in December, because that's what that article reported, okay? And then down here in the puts, the naked put gets purchased back, okay? We come out here and sell it, and also a subsequent article that came out just recently said that these numbers had changed from 520 or 500, where we're not 525 and 262.5. That's where the most recent information says. So it appears that maybe the trader amped it up just a squeege. Okay, so if you take these values here, with that $9 million loss on that week that was reported, Okay, here's what we had before the roll. Here's what we have after the roll, and you can see, and this loss here is very minimal. At those exact prices, we are down just slightly here in this flat. The goal, though, is for the trader to have had the break even over here, but at these prices, it could not be achieved. We're just underwater, well less than $1 million there. Okay, and I think it's the intent of the trader not to hold it to expiration besides that. So we keep that in mind as well. But here we are just shy of 10. And this was on, this was on the 20th. So we're rolling from the previous position that had just 28 days left, rolling it out to a position in December that had 91 days left. And away we go. Now, according to our information, at least in these articles, and looking at the volume levels, the trader is still sitting on this. You look at the open interest and volume levels, the trader is still sitting on this as we speak. So here is the day by day, and what I did is I did a deposit of $1 into this portfolio account. I labeled it VIX Elephant. And I don't know why it says January 3rd. I don't know, it could have, really, I started at July 20th with $1 in the account. And immediately, and then so that the net effect is that we're seeing the dollar amount of the profit and loss on this one trade. And I didn't want to put in millions and millions of dollars in the account because we just don't know what kind of margin this trader is operating on, right? Or how much capital that they have allocated to this trade. So this is just simply graphing the profit and loss level of this trade on a day-by-day basis. Underneath, starting on July 21st, we have the day-by-day bar of the VIX. Okay? It's interesting. You can see how, when we get started here, and even though the VIX is kind of just crawling along, the position starts losing right away. When the VIX climbs and comes up to 16, the position begins to make money finally. And the position was topping out at something just shy of $14 million, actually. And it doesn't correspond, even though the VIX came down. Look at this. The profit level went up. Why is that? Interesting. Okay, I'm going to show you something in just a little bit. In my next slide, that'll be the final one of the day. That'll kind of give us some kind of clue. But I have not chased it down in great detail. Notice then that as the VIX begins to drop and come down, clearly the profit levels begin to drop and come down dramatically. Look at that. Now the roll happened right here, okay? Okay, that's when we rolled. And then time went on. The VIX kind of crawled here under 10, at 10, kind of under 10. Okay, and as that time went on, the position kept losing money, presumably due to time premium. Okay. And then when the VIX popped up, kind of went over 12, the position began to make money and recover a little bit. VIX comes down below 10 again, kind of wobbles down. VIX climbs above 12, 13, onto 14. It climbs back, and then the VIX drops again down below 10. And of course, we're back down, and the position is losing roughly 30 million-ish, something like that now, according to the data that we have. The best guesses on the prices that were executed at that time. Now, I wanted to kind of look at this because if we roll it here and we're making money and we're losing that amount of money at maybe a 9.5 VIX level, you come over here and we're at about 10. Very, very similar VIX level, yet the position lost quite a bit. And I think that's going to be due to time decay, like I just showed you. Another thing I wanted to show you is that the actual implied volatility of the VIX options themselves can vary greatly. And just showing you here, the actual VIX, the implied volatility of the VIX options varies from, look at this, high of what, 275, 280 Down here it gets down to under 100. Very volatile, and you can imagine that the vertical and horizontal skews are flying around as well. I have not done that kind of analysis. Oh, just a second here. Sorry about that. Didn't turn the ringer off. That's it. I have Bach going on. Well, it depends on the ringtone for the person. But anyway, sorry about that. So there's some exposure here too. Call it Vega exposure, skew exposure, etc. And I have not gotten into the weeds. And those would be some deep weeds to venture into. But I just wanted to show you the fact that not only do you have time decay, but you could have some volatility exposure as well. Here's the most recent article that came out. And this came out on Bloomberg, as you can see. This came out last week. There was some conjecture that this trade was due to be rolled over. Okay, it was due to be rolled over, and they have they're calling him the VIX elephant. And I don't know, is there the 50-cent reference here? I don't know. I know it was in other articles. So it even went into the notion that this was last week. Here's the actual trade that would be happening. Figuring that the trader was going to roll from DECE over to Feb. And it was saying that even some of the futures market in the VIX was kind of quaking a little bit. And you were seeing tremors about the anticipation of this kind of trade going down. This rollover here of such substantial numbers. All right, and so that's what that article. Now, since then, I went day by day through those strikes. I didn't see any volume levels near approaching that, so presumably this trade is still on. And here we're at, it's roughly losing 30 million or so. So I included here, of course, you can print out the PDF of this presentation. You'll see the prices, the exact prices of this. You can kind of follow along if you want in the subsequent weeks, and we'll see how well 50 Cent does, or the VIX elephant, coined by another one of the journalists there. Okay, interesting, because when you look at this too, if there is a big, I mean, look how much can be made if this thing jumps to in the low 20s. I mean, look at that. Oh, here we go. I mean, if it were to go up in, above 20, you're making, or even above 19, you're making $100 million on this plus. All right, and when you go and look at this, I mean, this would be a big spike, okay, up to here, but on a big market down move, the risk-reward ratio, or the reward-to-risk ratio, is just outstanding on this. And let me just go and see. I mean, what has it gone to in the past? Look at that. I mean, it's conceivable, certainly, that it could go up to 20 on a big market down move. All right, and remember, those calls started at 15 right there. So they're playing just the reversion to the mean, and if that happens, I mean, that's where the legitimacy here of the idea really plays in. And of course, if we were to have another experience like in 2015, or early 2016, or mid-16, well, now you're in the mid-20s making 100 million or plus on that. So down 30 so far, however. So that's something to keep in mind as well. Folks, that's it for me on this. Any questions, comments, etc.? All right. Thanks a lot. We will see you next week. Take care. Have a great rest of the day.